Gold has been the bedrock hedge for many over the years, but before we get too carried away, we must remember it gives no dividend, it costs money to store, and it's quite volatile. So why should we be so wedded to it as an investment pillar? And I go for that for me as well, because that is something that I look at quite a lot. Tom Bailey is head of research at HANetf. This is the thing, Tom, isn't it? Is that gold is talked about in almost every single investor event we ever go to and ever cover. Clients always say, but what about gold? It is, as I say, the bedrock for some people, as I've explained. Let's take a look at gold and the outlook for this year, because we've seen it appreciate recently. What's the thought at HANetf about 2023?
Yeah, I mean, so obviously kind of in the context of what happened in 2022, so in 2022, gold in US dollar terms was roughly flat. It was up in sterling, though, if your viewers are investing in sterling denominated ETCs. And you know, on the surface you can say that's disappointing that it's flat in dollar terms, but actually if you compare it to the wider market, you can really see it's playing its purpose here, because obviously the S&P is down roughly 20% on the year, the Nasdaq about 30%, while gold being roughly flat. It kind of definitely plays a role here as a store of value. So as you say, it doesn't produce dividend, it doesn't produce income, but people often allocate a small portion of their portfolio to gold as this kind of diversifier, store of value, and particularly in times when markets are down to counteract that and save some of their performance. So it's definitely played its role it should have last year. So what it means for this year obviously is one, depends the outlook for markets in terms of where is the market going from here, but there is increasing talk about perhaps gold entering a bull market this year, and partly it's because of the key thing holding gold back last year really was the rate hikes coming from the Federal Reserve and central banks around the world, and that kind of comes back to your point about no income, is that the attractiveness of gold compared to income producing bonds decreases when obviously rates are going higher. So in a rising rate environment, gold can suffer, and that kind of held gold back a bit last year, despite obviously having appeal in other aspects, be it war, inflation, market volatility. So the question is, can this year we see the Federal Reserve kind of start to scale back their rate hikes, and it's increasingly looking like they might. At least they're slowing for the time being, it seems, and if in that kind of environment, then gold might start to kind of become more attractive, and the drivers of the price of gold, the other drivers of the price of gold being obviously as a hedge against volatility, inflation, and obviously a safe haven asset in a time of geopolitical uncertainty and war, kind of really start to shine. In terms of where the price is going, we wouldn't make a prediction itself. This is just kind of some of the reasons to be bullish on the price of gold. Although one of our partners, Eric Strand, who's the manager of our AUAG ESG gold mining ETF, ticker ESGO, he kind of often talks about, he thinks gold's going to enter a new bull market and perhaps might appreciate 20% this year.
Yeah, and in fact, if you look at the gold price, I think from the lows we had back at the back end of last year, it is almost up by around about that 20% mark, which would take it into a bull market. This is the chart here for the Royal Mint Responsibly Sourced Physical Gold ETC. This is in dollars. I know you do one in sterling as well. So this gives us sort of a pattern, and this basically follows the price of gold, doesn't it? So this is what's investable on the IG platform. I spoke at the top about the cost of storing gold. I mean, talking there about bullion.
Yep.
There's a lot of risks to that, of course, not least of which, of course, is theft. So you've got to insure against that, and of course the storage costs. One of the other things I like doing is investing in coins, because it means you don't have to pay any capital gains tax, because It is technically speaking currency. But one of the other areas of the market that we're quite often asked about is, how about investing in individual miners as a way to get exposure to gold? What's the outlook there, and what would you say about people who want to invest in those individual companies that produce the end metal?
Yeah, sure. So lots of investors do look to gold miners as a way to play a potential gold market or appreciation of the price in gold, and that's kind of, it's often seen as a more leveraged play on the price of gold. There's potentially more upside, of course that comes with potential for more downside if your view on the price of gold doesn't go the way you want. But it's often it's kind of seen as this kind of leverage play on the price of gold. Obviously, some gold miners it's a particular area of the stock market which kind of has historically been viewed as with a bit of skepticism by many investors. But what we kind of seeing, particularly research from Eric Strand, the manager of the ESGO ETF I mentioned, is that basically lots of these gold miners are becoming much more shareholder friendly, much more than they used to be. They're increasing their dividends, they're increasing their share buybacks at the same time, but crucially, obviously for investors, they're much more capital disciplined than they used to be. So they're much more sceptical or withholding about opening new projects. And so I think Eric Strand argues that they're much more investable than they used to be. Now, you mentioned about individuals buying individual stocks in gold mine companies. Our HANetf, we've got our ETF, which tracks a basket of 25 gold miners. And that's because while obviously there is this argument for buying gold miners, at the same time there's the idiosyncratic risk of each one. Is it made a bad decision on a project? Is it going to get is going to run into trouble in those jurisdictions? Obviously there's always the political football around mining in certain jurisdictions, and so having rather than trying to pick the best gold miner, having a kind of broad approach of a basket of gold miners, we think is much more preferable solution if investors do want to go down this gold mining route. And at the same time, our gold mining ETF is particularly unique in that we run an ESG screen on the sector. So we only include the 25 highest rated in an ESG sense gold miners. This is to kind of ensure that they're not ones that might fall foul of political controversy or end up facing fines for bad practices anywhere, which obviously is always a concern for investors in this kind of sector. And at the same time, those 25 stocks, we then equal weight them, so we remove the concentration risk, which kind of comes back to the diversification point I was making about having a broad exposure to gold miners rather than trying to pick one or two that you think are the best.
This thing about ESG is interesting, and it's coming up more and more for me as someone that asks questions of chief executives. And it seems to me that it adds expense to the bottom line for companies, the environmental, the social, the governance, and making sure that it complies with local, as you say, political initiatives and so forth. So it is an added expense. How important and how concerned should we be as investors in this area about ESG?
Yeah, well, so we carried out a survey of professional investors asking their attitudes towards gold and ESG, because there is this very much, many investors view gold as a necessary asset class to hold, and at the same time ESG is increasingly a requirement for many investors. And so we carried out a survey of professional investors to see kind of what their attitudes were, and their view was really that funds that are not gold funds or products that are not taking into account ESG concerns are going to lose money to those that are. And it's kind of really just it's part of this overall trend towards ESG. And so so we have as I mentioned, our gold mining ESG ETF. But really one of the big initiatives we've done over the last year is with our gold ETC, which you mentioned, the Royal Mint one, RMAU, which was the introduction of recycled gold into this ETC. So whereas kind of other issuers who don't work with something like the Royal Mint, they don't have complete control of the supply chain of the gold that backs ETC. We do, because we work with the Royal Mint. The bars are all stored in the Royal Mint's vaults in their ex-MOD site in Llantrisant in Wales, and so kind of, and it's all accounted for. And so we took the step to introduce recycled gold last year, and this is gold that was basically scrap gold from the Royal Mint's industrial functions, because obviously they produce the coins you mentioned, and obviously when they're doing that, there's gold left over. So these gold bars, which now partially back the ETC, it varies because obviously the inflows and outflows of the money and sourcing the gold bars, there's not unlimited amount of recycled gold, but we, to best endeavours, try and have as much of that recycled as possible. And so the idea being that kind of a portion of it we back with recycled gold, and really you can look at the stats in various studies and stuff, about 90%, recycled gold is about 90% less carbon intensive than non-recycled. So we very much feel this it definitely appeals to the investors who are concerned about ESG, the carbon footprint of a portfolio, but at the same time obviously want exposure to a core asset class.
Interesting. Okay, look, Tom, we'll leave it there. Thanks for joining us. It's a fascinating subject and much talked about as well amongst IG clients. That is the head of research at HANetf, Tom Bailey. If you want to catch up with Tom and his team, you can do so through the HANetf website. I'm assuming that's the case.
Yeah.